Most people think gold rises when fear rises and then falls when fear fades. I think that is far too simple. I think something much bigger is moving under the surface right now. What looks like a gold rally may actually be a quiet vote against the whole paper system. And if I am right, the next reset will not begin with a headline. It will begin with people realizing the headline came late. If you like hearing the part of the market story that usually gets edited out, stay close to this channel, because this is one of those moments that only looks obvious after the money has already moved. I have watched markets long enough to know that the biggest shifts rarely announce themselves in plain language. They hide inside charts, reserve data, policy choices, and small changes in behavior. Gold is starting to tell that story again. When I hear people explain gold, they usually point to one thing: inflation, war, rate cuts, a weak dollar, fear. Those things matter, but they do not explain why central banks have been buying gold at a pace we have not seen in decades. They do not explain why the people closest to the plumbing of the global system are acting as if trust itself is being repriced. That is what I mean by a reset. I do not mean a movie scene where one world order ends in a single night and a new one appears by morning. I mean the slow and then sudden reset of what counts as real safety. I mean the market deciding piece by piece that an asset with no promise attached to it may be safer than an asset backed by a promise that can be changed, delayed, diluted, frozen, or weaponized. I have seen this movie before, just in a different form. In 1971, the United States closed the gold window. That meant foreign governments could no longer turn dollars into gold at the old fixed price of $35 an ounce. That one move changed the global money system. It did not kill gold. It removed gold from the front desk and pushed it into the basement, where it kept doing the same job in silence. From that point on, the world ran on paper money with floating exchange rates. That simply means currencies were no longer fixed to gold and could move against each other. It gave governments more room to print, borrow, and manage crises. It also created a new kind of power because the country behind the reserve currency, the main currency held by other countries, gained huge influence over trade, debt, and finance. For a long time, that system looked strong enough to carry almost anything. The dollar stayed dominant. U.S. Treasury bonds stayed deep and liquid. Liquid just means easy to buy and sell in large size. Gold looked old-fashioned to many people, like a relic from another age, useful for jewelry or fear trades, but not central to the modern system. I never believed that story completely. Gold did not stop mattering just because people stopped talking about it as money. Central banks kept holding it. Governments still counted it. In crises, people still ran toward it. That told me gold had not lost its role. It had only lost the public's attention. Then the cracks started to widen. The financial crisis in 2008 reminded me that leverage can make safe assets behave in very unsafe ways. Leverage means borrowed money piled on top of borrowed money. Then the pandemic showed me how fast debt can explode when governments need to backstop the system. Then came the moment that, in my view, changed how many countries think about reserves forever. That moment was the freezing of Russia's foreign exchange reserves after the invasion of Ukraine. I am not making a moral argument here. I am making a market argument. A reserve is supposed to be the part of national wealth a country can trust in an emergency. When a large chunk of reserves can be frozen by other powers, every central bank in the world gets a message, whether it says that message out loud or not. The message is simple. Your reserves are only truly yours until politics says otherwise. That changes behavior. I do not have to like a country's choices to see the lesson other countries took from it. If I am a reserve manager sitting in Asia, the Middle East, Eastern Europe, Africa, or Latin America, I suddenly care a lot more about assets that do not depend on another country's permission. That is one reason the gold buying has been so striking. Central banks bought a record 1,082 tons of gold in 2022. They bought another 1,037 tons in 2023. Then they added about 1,045 tons in 2024, which made it 3 straight years above 1,000 tons, far above the roughly 473 ton yearly average from 2010 to 2021. That is not noise. That is a pattern with intent behind it, and the surveys matter too. In a 2025 World Gold Council survey, 95% of central banks said they expect global central bank gold reserves to rise over the next year. Even more striking to me, 43% said they expect their own gold holdings to rise. None expected a decline. I do not ignore numbers like that because central banks do not move in herds by accident. If I place myself in the seat of one of those reserve managers, the logic becomes plain. I hold dollars because I need them for trade, debt payments, and market access. I hold treasuries because they are big, active, and still central to the system. But I also see a world with more sanctions, more trade conflict, more debt, more election-driven policy swings, and less trust between major powers. In that world, gold starts to look less like an old metal and more like neutral insurance. Neutral matters. Gold does not owe me a coupon. A coupon is the interest payment a bond gives. Gold does not promise cash flow, and people love to mock that. But it also does not require trust in a central bank, a treasury department, a parliament, a payment network, or a foreign court. In a fragile world, that lack of dependence becomes a form of strength. This is where many people stop thinking too early. They hear that gold yields nothing, and they think the argument is over. I think that misses the whole point. Fire insurance also yields nothing until the fire comes. Gold is not there to beat every asset in every year. Gold is there for the years when confidence itself gets marked down. And if you had to park a part of your life savings somewhere for a world that feels less stable each year, would you want every dollar tied to somebody else's promise? Or would you want at least one asset that sits outside the promise machine? I ask myself that often. I think more people should, because that question gets to the heart of why this move is bigger than a normal bull market. Now, I want to bring the United States into this because this is where the deeper tension lives. U.S. debt is now around $39 trillion. That number is so large, people stop feeling it. But scale matters because debt changes policy. It narrows choices. It makes low rates more tempting, inflation more useful, and currency discipline harder to defend over time. Interest on that debt is no small detail either. In fiscal year 2025, the federal government spent about $970 billion on net interest. That is money paid just to carry past borrowing. It does not build roads. It does not train workers. It does not invent new technology. It is the carrying cost of a system that has grown used to borrowing more than it can comfortably fund. I am not saying the dollar is finished. I am saying the burden under the dollar is getting heavier. That is different. Reserve currency status can last a long time, even with deep flaws. But when debt rises, politics hardens, and outside powers lose trust, the system does not usually break in one clean snap. It frays at the edges first. Gold tends to notice that before the average investor does. That is why I pay close attention to who is buying, not just to the price. In 2024, Poland was the largest reported central bank buyer, adding about 90 tons. Turkey added around 75 tons. India added about 73 tons. China reported adding 44 tons, even after pausing its updates for several months. These are not random hobby purchases. These are state-level choices made by institutions that think in decades. I also watch where the gold is stored. In 2025, more central banks reported domestic storage of gold than the year before. Some countries have repatriated gold from foreign vaults back home. Repatriation just means bringing an asset back under direct national control. To me, that says something very clear. This is not only about owning gold, it is also about making sure the gold is close enough to matter in a crisis. That one detail tells me the reset is not just financial, it is political and strategic. Gold is turning back into a trust asset in a world where trust between states is fading. It is becoming a form of reserve independence, not total independence because no country escapes the system fully, but more room to breathe when the system gets tense. That room matters more than most people realize. If you still think this is only about inflation, ask yourself why central banks kept buying even when real interest rates rose. Real rates are rates after inflation. In theory, higher real rates should make gold less attractive, yet the buying kept coming. That tells me official buyers were not chasing a simple trade. They were responding to a structural shift in risk. Private investors are only now starting to catch up to what official buyers have been signaling. When gold broke above old highs, a lot of people treated it like a chart event. I did not. I treated it like confirmation. A market can flirt with a level for technical reasons, but it does not live at new levels for long without a deeper change in demand. Central bank demand helped create that floor of conviction, and the supply side does not solve this quickly. Gold mining does not turn on like a faucet. New mines take years. Permits take time, costs rise, ore grades fall. Even if the price moves hard, the physical supply response is slow. That matters because resets become powerful when rising demand collides with slow supply. I think people also forget how history behaves after monetary trust breaks. After the old dollar-gold link snapped in 1971, gold did not just move a little. By January 1980, it had reached about $850 an ounce. That was not because the metal itself changed. It was because the public finally priced in what the monetary break really meant. Trust took time to reset, and gold rose while that reset spread through the system. I am not saying history repeats in a perfect way. It never does, but it rhymes more often than people admit. Back then, the problem was the strain of too many dollars against too little gold. Today, the problem is broader. It is too much debt, too much financial weaponization, too much political strain, too much dependence on paper claims, and too little trust that the rules will look the same in 10 years. That is why I think this coming reset may be bigger than the last one in one crucial sense. In 1971, the center moved and the rest of the world had to adjust. Today, the center is still moving, but the rest of the world is also building ways to reduce dependence on that center. I see that in reserve behavior, bilateral trade deals, local currency settlements, and gold accumulation. No single move replaces the dollar. But together, they weaken the idea that one promise can anchor the whole world forever. I want to be fair to the skeptical view because it is not foolish. The skeptic says the dollar still dominates trade and finance. U.S. markets are still the deepest in the world. Gold cannot run a payment system, settle energy flows at global scale, or replace the treasury market. I agree with most of that. Gold is not about to become your checking account or the world's daily settlement tool, but I think the skeptic misses the level where this shift is happening. Gold does not need to replace the dollar to reset the system around the dollar. It only needs to become more important at the margin. The margin is where price gets set. If countries hold a bit less faith in paper reserves and a bit more wealth in gold, the signal grows. If that happens for years, not weeks, the repricing can be large, even without a formal new gold standard. And if the world never announces a reset, would you even notice one while it was happening? Or would you only notice it after gold had already moved far enough to force the conversation? That is another question I keep in my own head. Big structural changes often look boring at first. They show up as reserve reports, policy footnotes, and strange strength in a market people still think they understand. There is also a quiet power angle here. Gold is one of the few reserve assets that is no one else's liability. Liability just means something one side owes another. A bond is somebody's liability. A bank deposit is somebody's liability. Gold is different. In a world that feels more divided, more sanctioned, and more fragmented, that difference gets bigger. Power does not just sit in armies and trade routes. It also sits in what other people cannot freeze. I can already hear the next objection. If gold is so important, why are governments not saying it clearly? Because governments rarely say the quiet part clearly when the quiet part reveals anxiety. They do not want to signal distrust in the very system they still need to use. So they act first and explain later, if ever. That is why I focus on what they are doing with reserves, not what they say in speeches. What happens next from here could take more than one path. In the first path, we get a slow burn. Central banks keep buying. Deficits stay high. Growth weakens in waves. Confidence in fiat money, government issued money, fades a little more each year, and gold grinds higher in a long, frustrating climb that many people miss because it is not dramatic enough day to day. In the second path, we get a sharper shock. It could be a debt scare, a sudden drop in the dollar, a bond market accident, a wider war, or a policy mistake that breaks confidence faster than expected. In that case, gold would not move like a calm hedge. It would move like an escape valve. The public would rush in late and the move could become disorderly very fast. In the third path, we get a messy false start. Gold surges, then corrects hard. People declare the story dead. Then the same structural pressures keep building under the surface, and the next move starts from a higher floor. I have seen that pattern in many long cycles. A deep story does not end just because price pauses. In fact, pauses are often where the weak hands leave and the strong case keeps forming. So what do I watch if I want to know whether this reset is real? I watch central bank purchases. I watch reserve repatriation. I watch U.S. deficits and interest costs. I watch the bond market for signs that financing the debt is getting harder. I watch whether gold stays strong even when the usual textbook reasons say it should weaken. When a market refuses to obey the old script, I pay attention. I also watch the behavior of ordinary investors because that tells me where we are in the cycle. Right now, many people still treat gold as an optional side trade. They see it as something to rent during fear and drop during calm. I think that mindset belongs to the old world. In the new world forming underneath us, gold is moving back toward the center as a form of trust that does not need a middleman. That does not mean I go all in on gold or stop believing in productive assets. I do not. I still respect businesses, cash flow, and innovation, but I do not confuse growth assets with crisis assets. I do not ask gold to do the job of a great company, and I do not ask a great company to do the job of gold. When systems get strained, each asset reveals what it was really built for. If I were thinking practically, I would keep that distinction clear. I would not chase gold like a lottery ticket. I would not use heavy leverage on it because leverage can turn a good idea into a forced sale. I would think about it as monetary insurance, not entertainment. And I would remember that insurance always feels expensive right before the event that proves it was cheap. So when I look at the title of this moment, I do not see a shiny metal getting lucky. I see a warning from the part of the system that still remembers what trust feels like when paper promises start to wobble. I see central banks voting with tonnage. I see debt closing in on policy. I see geopolitics changing the meaning of reserves. I see gold slowly regaining a job many people thought it had lost. That is why I believe the biggest gold reset may still be ahead, not behind us. Not because the world is ending and not because gold solves every problem, but because the foundation under money is changing and gold is one of the few assets that does not need the story to stay stable in order to matter. When confidence becomes the scarce asset, gold stops looking old. It starts looking honest. And in the end, that is what every reset is really about. It is not just price. It is not just policy. It is the moment people realize that what they called safe was only safe as long as the story held together. Gold matters when the story frays. And the closer we get to that truth, the less this move will look like a rally and the more it will look like a reckoning. I have learned to respect the assets that survive fashion survive politics, survive experts laughing at them, and survive long stretches of neglect. Gold is one of those assets. It waits. It says very little. But when the system starts doubting itself, gold does not need to raise its voice. It only needs to be there. Paper wealth can grow fast, but trust is the asset everything else borrows from.